Welcome to this lecture on internal control components, control activities. In this session, we'll explore what control activities are, how they operate, and why they form the backbone of an organization's ability to execute its objectives with integrity and efficiency. Control activities are the specific actions, policies, and procedures that help ensure management's directives are carried out. They are the tangible mechanisms that prevent, detect, and correct errors or irregularities. In short, control activities are where strategy meets execution. They turn plans and policies into practical safeguards. According to the COSO framework, control activities exist throughout the organization, at all levels and in all functions. They may be manual or automated, preventive or detective, but their purpose is always the same: to reduce risk to an acceptable level. Let's break down the key principles that define effective control activities. The first principle is selecting and developing control activities that mitigate risk. Once risks are identified through risk assessment, management must design controls that address those risks directly. For example, if the risk involves unauthorized payments, the control might be requiring dual approvals for all disbursements. If the risk involves data breaches, access restrictions and encryption serve as protective measures. The second principle is developing general controls over technology. In today's digital world, technology supports nearly every business process. That means IT controls, such as access management, change management, and system security, are vital to maintaining reliability and preventing data manipulation. Even the strongest operational controls can fail if the systems behind them are compromised. The third principle is deploying control activities through policies and procedures. A control is only effective if people understand it and follow it consistently. Clear documentation, regular training, and leadership enforcement ensure that controls become part of the organization's daily routine. Control activities can take many forms. Let's explore a few common categories. First, authorizations and approvals. These controls ensure that transactions are reviewed and approved by the right level of authority before execution. For example, large purchases may require executive approval, while smaller expenses may be delegated to department heads. Second, reconciliations. These are the periodic comparisons of two sets of data, like bank statements and accounting records, to identify and correct discrepancies. Reconciliations are detective controls that help ensure the accuracy of financial information. Third, verifications. These involve checking the accuracy and completeness of information. For instance, verifying vendor invoices against purchase orders and delivery receipts ensures that payments are legitimate and accurate. Fourth, segregation of duties. This is one of the most fundamental internal control concepts. It ensures that no single person has control over all aspects of a transaction. For example, the person who approves a payment should not also process it and record it. Segregation reduces the opportunity for fraud or error by requiring multiple individuals to participate in key processes. Fifth, physical controls. These include locks, access cards, safes, and security cameras that protect assets from theft or misuse. Even in the digital era, physical safeguards remain critical for securing cash, inventory, and sensitive documents. Sixth, performance reviews and analytical procedures. Comparing actual results to budgets, forecasts, or prior periods helps identify unexpected variances that might indicate control weaknesses or irregularities. Together, these activities form a network of protection that supports reliable operations and accurate reporting. But remember, controls must strike the right balance. Too many controls can slow down processes and frustrate employees, while too few can expose the organization to unnecessary risk. Effective control design finds the middle ground between efficiency and security. Another key factor is automation. Many organizations now use software to enforce controls automatically, such as flagging unusual transactions, preventing duplicate payments, or limiting access to financial systems. Automation not only reduces human error, but also provides audit trails that strengthen accountability. Let's consider a simple example. Imagine a retail company where cashiers handle daily sales. To prevent theft or error, the system requires each cashier to reconcile their cash drawer at the end of every shift, with a supervisor verifying the count. The accounting system automatically flags discrepancies exceeding a set threshold. These are examples of preventive and detective control activities working hand in hand. It's also important that control activities adapt to change. As organizations grow, adopt new technologies, or face new regulations, controls must evolve. Periodic reviews and audits help ensure that controls remain effective and aligned with business objectives. In summary, control activities are the operational heartbeat of internal control systems. They translate risk management strategies into daily actions that safeguard assets, ensure accuracy, and promote compliance. By combining clear policies, technological safeguards, and human accountability, organizations build resilience and trust. In our next lecture, we'll explore information and communication, the component that ensures vital control information flows efficiently across all levels of the organization. Thank you for joining me in this session on control activities.